Hello, I'm Gaurav Sharma. I'm an oil market analyst and a senior contributor to Forbes.com. Today we are here to discuss the oil market. Of late, we have seen oil benchmarks, both Brent and West Texas, flirt with the $40 level. In Brent's case in particular, the last few sessions saw Brent touch a high of above $42. What has gotten us here? If you look at the last 3 to 4 weeks, we've had the OPEC Plus summit, where they took a decision to roll over 9.7 million barrels per day in output cuts by a further month from July the 1st. But immediately 24 hours later, the Saudis came back and the Saudi oil minister, Prince Abdulaziz bin Salman, declared that they were making voluntary cuts of 1 million barrels per day, which would no longer be the case from the end of June. The Saudis also raised their official selling prices in response. Now, could we say that the worst for the oil market in terms of the COVID-19 situation is behind it? I beg to differ. Because for starters, we can only talk about the threat of a second wave of the COVID-19 pandemic when we've got a handle on the first wave. And if you look at economic powerhouses like India and Brazil and you see the situation there and the data coming out of there, it sort of highlights the demand complexities that we are facing, that the market is facing right now in terms of the direction of travel for oil demand for the remainder of 2020 and for Q1 2021. Now, the worst might well be over for some OECD economies. Major European economies such as France, Spain, Italy and the UK and Germany are indeed opening up. But will that be enough to sustain the demand momentum? I think not. Instead of looking at it from the perspective of geographies, I think what we should be looking at it is from the perspective of sectors. And the aviation sector is having a torrid time. Aviation is a huge driver of oil demand. So unless aviation activity gets back on track, which in my opinion is unlikely to be before the first quarter of 2020, and in the absence of a vaccine, oil demand will remain stunted. Much has been made about China returning to its average importation levels of 14 million ppd. That to itself remains a little bit of a pipe dream because we've had secondary outbreaks of COVID in China. So what we have here is that OPEC has pretty much for the next few months at least provide some sort of certainty on where the supply situation will be. But in terms of the demand situation, things are pretty fluid. All the big five importers, that would be China, US, India, Japan and South Korea, are sort of in a holding pattern. And that pattern entails is that while they're getting to grips with the COVID-19 pandemic in their own ways and at their own speeds, much of 2020 is pretty much a write-off in terms of heightened demand activity. In fact, we could lose as much as 10 years worth of demand growth this year alone, thanks to COVID-19. And what we have here is a situation whereby which regular economic activity may not come back till Q1 2021. So right now, the prices are just either side of $40 in terms of Brent, and for the West Texas, it's just below $40, somewhere in the region of $36 to $37. This situation is likely to last, and this level of oscillation is likely to persist until and unless we have a clearer picture versus COVID versus the global economy. And I think that is the direction of travel here. If you're taking a bet on the market, it could be a 300-point spread either side of the $40 mark. But right now, escaping the clutches of late 30s, early 40s looks highly unlikely, at least for the next 2 to 3 months. And come the end of the year, if you're incredibly lucky, we could possibly count on average $40 average oil prices using Brent as a benchmark. But right now, things are pretty fluid. And to declare mission accomplished at 40 and that the only way is up would be a fallacy. Thank you for listening.